Good morning. I'd like to welcome all of our attendees over the internet to our January main event program for the Silicon Valley chapter of AAII.
Now, it's my great pleasure to introduce Senior Vice President, Associate Director of Research at the Federal Reserve Bank of San Francisco, Robert Valletta, PhD. He's going to cover the economic environment. There'll be a lot of focus on the impact of the virus. We all know that that's been a horrible situation. And the Federal Reserve's best assessment of inflation, GDP, the recovery, and the overall impact. Rob Valletta is Associate Director of Research in the Economic Research Department at the Federal Reserve Bank of San Francisco. Short form is FRBSF. And in addition to his general department leadership, his key duties include overseeing the department's external publications, providing advice on monetary policy, and supporting the public speeches of the bank president, that would be Mary Daly, and other senior staff. Valletta's scholarly research is primarily in the field of labor economics, including unemployment, jobs, poverty, and health insurance.
Thank you, Bill. It's a pleasure to be here. Good morning to everyone. I wish that I wish we were all in person, but obviously that's not an option at this point, and we're hoping it's an option for this kind of event later on, sometime later this year, fingers crossed. So my talk is going to be focusing on the U.S. economy and whether it's on the mend in 2021. And just to kind of give away the bottom line in advance, the answer to that title question is yes, it looks to be on the mend in 2021. But it's unlikely to be fully healed by the time the year is up. The coronavirus pandemic left a huge hole in the U.S. economy. It's going to take a sustained period to dig our way out of that. And I'll be going over the reasons for that during my presentation. One thing I should emphasize that's also on this title slide is that there's always a disclaimer attached to any public presentations by Federal Reserve staff. That disclaimer is listed there underneath my name and title. It's just so that nobody interprets my remarks as representing the broader views of the Federal Reserve or any other individual in the Federal Reserve. I'm speaking for myself with input from the forecasting staff at the San Francisco Fed. So with that out of the way, let's turn to a summary of my presentation and excuse me, in the economic outlook. Some of this is pretty obvious, but just to kind of set the stage for the details I'll be going into later, the COVID-19 pandemic caused a severe contraction in the U.S. economy almost immediately upon being recognized as a pandemic. There's a meaningful recovery underway, and it's been underway for 6 months or more. But the labor market, the huge hit to the labor market and the economy in general are far from healed, and it's going to take quite a while to get there. Inflation, which is one of the major aspects of the economy that the Fed focuses on, that's been mired for a sustained period below our 2% target. And with the COVID pandemic and weaker economy, it slipped further below that target. So that's an issue that we're going to be grappling with going forward. 2021 certainly looks better than 2020, but the risks of a slow recovery remain in place, and we're seeing some of those risks manifesting themselves even recently with the virus resurgence and the shift towards more permanent or persistent damage in the labor market. And I'll talk about that as well. And given all this backdrop, Federal Reserve monetary policy is expected to remain highly accommodative, that is very stimulative for a sustained period. And that's not secret in any way. That's when the FOMC meets and announces their policy plans, that's been one of the main points they've been making, is that they expect to remain highly accommodative for a long period. So that's the summary. Now I'll be going into some more detailed data points and our forecast. So as probably all of you know, our main measure of overall economic activity in the United States is gross domestic product, or GDP. And this shows a plot of the 4-quarter change in real GDP since 2010, and looking ahead a few years. That's the solid blue line. And then we have our forecast dashed line in this plot. And what you can see is that in early 2020, there was a huge drop in GDP. In a single quarter, GDP fell by almost 10%, about 9% relative to the year earlier. That's just essentially, it's historically unprecedented to see a single quarter drop in GDP that's so large. Now, there was a substantial bounce back in the third quarter, and it looks like some of that recovery continued into the fourth quarter, although at a much slower pace than the recovery continued in the third quarter. Now, we're expecting that recovery to continue, and you can see this huge upward bounce in the second quarter of 2021 as we compare that to the really terrible second quarter of 2020. And it kind of looks like, okay, well, maybe at that point, we had this terrible downturn, and then we've got this really tremendous bounce back. Maybe we'll be back to normal. The thing to keep in mind is that we're not going to be back to normal in mid-2021. It's going to take a few years to get there. The reason for that is because this should all be compared to what we would expect to be normal growth. And so the green line in this plot is what we call our trend growth estimate, or normal GDP growth over a multi-year period. That's in the range of 1.5% to 2%. So when the economy, when GDP contracts, like it appears to have done in 2020 by about 2.5 percentage points, that's not measured relative to zero. That's measured relative to what we would normally expect growth to be, or that the benchmark for what we've lost is what we would normally expect growth to be. So we've got a lot to make up for going forward. You can see that in this next chart that shows the level of GDP. So not the percentage annual change in GDP, but the actual level of GDP. Again, that's the blue line. And that's displayed relative to the green pre-COVID trend line. So what happened is that we were around, we were about a trend in early 2020, and the terrible hit from COVID pulled the U.S. economy well below trend. And even with above trend growth for some years, it's going to take us quite a while before we get back to that trend line, because we've got so much lost output to make up for. So much growth to make up for that it's going to take some years to get there. This is a standard pattern in recessions where where the economy takes a dip. Not only is growth negative, but it's well below what would be normal growth. So that just kind of cumulatively adds up to a big hole in the economy. And so even when a recession has been officially declared over, most people don't feel like the economy is anywhere near normal. And that's because in order to get back to normal, it typically takes some years to catch up to what would have been normal growth. So that's why when people, the recession over announcement is not an all clear signal for the economy. It just means that the worst of it is over, and then we've still got a ways to go before we're truly back to normal. Now, the other thing I should point out is that this forecast that I'm showing you for GDP coming from the San Francisco Fed, that's actually our forecast as of mid-December. We're going to be updating that forecast in the near term. Probably next Friday, there will be a public release of our updated forecast via a document I'll mention at the end of my talk. But there's been positive and negative developments since December that probably wash out and make this forecast probably not far off from what we're going to be issuing in terms of our updated forecast. The outlook for government spending has improved somewhat. We're expecting more fiscal stimulus in 2021 than we were before because of the shift in Washington, D.C. politics that we've observed over the last week. So there's likely to be a little more fiscal stimulus than we had originally built into our forecast, and we'll adapt to that going forward. That's on the upside. On the downside, the news on the virus has been worse than many people expected, and that appears to be holding down growth in the fourth quarter of last year and the first quarter of this year a little bit more than was initially anticipated. So those factors are likely to essentially wash out in our forecast. Now, what I just mentioned, the fact that the virus resurgence appears to be exhibiting a restraining impact on growth, you can see that in the monthly jobs numbers. So for people who don't closely follow the economic news on a daily basis, yesterday the monthly employment report from the Bureau of Labor Statistics came out announcing the number of new jobs that were gained or lost in the U.S. economy. This plot shows in the yellow bars the monthly change in payroll employment. This is one of our best, almost real-time indicators of economic activity in the United States because it comes out on a monthly basis and is based on a very large survey of establishments, of employers. And so we have a really good sense of just how many people are gaining or losing jobs. You can see the huge hit from COVID in April of 2020. That's that really large negative bar. That was a single month loss of a little bit over 20 million jobs. Again, historically unprecedented. The magnitude of the hit to the economy and the labor market cannot be overstated. It was just, we've never seen anything like this. There was, this huge widespread shutdown and millions and millions of people thrown out of their jobs. Now, as things started to open up again a little bit after the virus was initially brought under a little bit of control, we saw some sharp rehiring activity. And so, for example, in the month of June, 2 months later, nearly 5 million people found jobs, and the employment count increased by nearly 5 million. And there were several million jobs gained after that. But as you can see, those yellow bars keep on getting smaller and smaller. The blue line is just the 6-month average of those bars. And then in the latest month announced yesterday for December, we actually lost jobs, or about 140,000 jobs lost in December. So the virus resurgence, the renewed containment measures, that's causing a pullback in economic activity, and we saw some reduction in the job count as a result of that. Now, that's also reflected in the unemployment rate. This is a plot of the unemployment rate. You can see that it was coming down for a sustained period leading up to 2020, and we actually got down to below 4%, a level that many people thought wasn't possible to achieve in the modern U.S. labor market. But we were down there. We were holding steady at around 3.7 to 3.8%. Then COVID hit and unemployment shot up to 14.7% in April, the highest number recorded since the Great Depression of the 1930s. Now, again, given the rapid bounce back in hiring activity, the rehiring of many people who were laid off in the initial downturn, that unemployment rate came down very quickly. In recent months, it's been down a little below 7% at 6.7. So that's still quite elevated relative to a normal, healthy labor market, but certainly much better than the 14.7 that we experienced last April. Again, in a sign of slowing in the recovery, that unemployment rate did not change between November and December. Yesterday's employment report released the unemployment rate for December, and that was 6.7, the same as in November. And again, that's consistent with the slowing in labor market activity and the renewal of containment measures that are keeping some employers from rehiring people and ramping back up to normal activity levels. We're still down about 10 million jobs relative to February of last year. So again, that's a huge hole to dig out of. Hiring is likely, the rehiring process is likely not to be as fast going forward as it was during the summer of 2020, and so we're expecting the unemployment rate to fall slowly over the next couple of years, back towards what we call the natural rate. That's that green bar that's a little bit under 4%, which is basically you can think of as kind of a healthy, sustainable unemployment rate for the U.S. economy to achieve. Now, with all this weakness in the economy and the labor market, we're seeing very weak numbers on inflation as well. When overall demand for goods and services is depressed, that tends to put downward rather than upward pressure on prices, and that tends to pull the inflation rate down. The Fed has set a 2% target or 2% goal for inflation measured by the Personal Consumption Expenditures, or PCE, Price Inflation Index. That's the level of inflation deemed to be consistent with a relatively healthy, stable, growing economy. You can see that we were below that target for most of the period, most of the recovery from the Great Recession, even towards the tail end when almost everyone acknowledged that the economy was in really good shape, was performing very well, was very strong, unemployment was very low. We still were seeing inflation mired below 2%. And of course, with the hit from COVID, inflation fell even further below that 2% target. Now, we do expect later this year to see inflation temporarily reach that 2% target, but that's just going to be some bounce back from the really low numbers we were seeing in spring of 2020. So that's likely to be a temporary blip up to 2% that we're going to have to look past and think about a longer-term sustainable recovery to that 2% inflation target. So again, that's going to take a few years out to 2023 and beyond before we anticipate getting back to the 2% inflation target. Now, with all of these developments in the economy, the Fed has taken a very, very accommodative posture on monetary policy. So what this plot shows is various interest rates, and most importantly, the federal funds rate, which is our main policy rate. It's basically the overnight lending rate that banks charge to each other for funds in overnight lending markets. That's basically got a bound of around 0 or so. In the U.S., we don't try to lower that rate anywhere below 0. And so coming out of the Great Recession, that federal funds rate was basically at 0 for a sustained period. And as soon as COVID hit, we had a couple of emergency FOMC meetings. I was actually at one of them last March. That's not secret. I attended it and sat through it. We had it on a Sunday morning, 9 a.m. Eastern time. So I had to go into the Federal Reserve Bank at 6 a.m. our time for this secret emergency meeting that then got announced publicly. And the federal funds rate was dropped to 0% once again, and that's intended to stimulate economic activity by keeping borrowing rates low and making sure there's plenty of liquidity in the financial system. Other interest rates, of course, tend to follow that, and so interest rates in general are quite low. Now, this drop to essentially just above 0% federal funds rate, that's not the only policy action that the Federal Reserve took. I'm reminded of The Cat in the Hat. I've been reading that book quite a bit to my 3-year-old grandson, so I kind of have The Cat in the Hat in my mind. And there's one scene in The Cat in the Hat where he says, that's not all I can do. And so he's balancing on a ball, and he's holding a cup, and he's twirling an umbrella, and he's got something on his nose, and he's doing all these things. Well, the Fed, when it comes to the federal funds rate, that's not all the Fed can do. So a number of other steps were taken. Right in March, when the federal funds rate was dropped to its lower bound, there was a wide variety of emergency lending facilities that were set up because financial markets were roiled by this. There was a lot of disruption in normal financial market activity. The Federal Reserve is a lender of last resort. So under the authority of congressional authorization, the so-called 13.3 provisions for emergency lending by the Federal Reserve. 9 different emergency lending facilities were set up to support household, corporate, and state and local borrowing activities. Those were funded by monies that were allocated via the Federal CARES Relief Act that was passed in late March. Now, some of those lending facilities have been terminated, but some are continuing into 2021. Markets have largely calmed down, so I think there's a widespread hope that those emergency lending facilities will not need to get used on a widespread basis going forward, but they are something that is available and can be ramped up again very quickly if needed. The other thing the Federal Reserve has been doing is that it's been signaling very clearly and strongly and consistently that the Fed expects the federal funds rate to stay low for a sustained period. That expectation of low short-term interest rates tends to help keep longer-term interest rates down as well. And to add to that, the Federal Reserve is doing lots of longer-term asset purchases. So our purchases of Treasury bills at about $80 billion a month and another $40 billion a month in mortgage-backed securities, that tends to help keep long rates down as well. And those low interest rates tend to keep borrowing rates low, tend to keep the financial system very liquid, keep funds available, and that tends to support a revival of economic activity when the time is right. So lots of policy actions going on initially in the crisis and continuing as we go forward. So with all that policy support, it seems to have had a very salutary effect on the economy in 2020. We saw some revival in various types of consumer purchases that are dependent on low interest rates. So auto sales went back up quite a bit, and they're actually back close to normal levels, pre-pandemic levels. Other sorts of household spending has held up fairly well. So those borrowing rates do seem to be having a favorable impact. Those low borrowing rates are having a favorable impact on economic activity. And with that, we expect the economy to continue to recover in 2021. But there are some risks on the horizon. Some of them not even really on the horizon. Some of them are with us now, and it's not clear just how severe their impact will be. So in the final part of my talk, I will discuss those a little bit. So the 2 main risks I want to talk about are the virus resurgence and the possibility of structural damage that persists for a sustained period in the labor market and the economy. So the virus surge is kind of scary. Here's a plot of what I'm talking about. This is a plot of new daily coronavirus cases, officially reported cases via the U.S. healthcare system. This is a 7-day average of the daily rate. So this is the daily number of new cases averaged over a 7-day period. That's that yellow or gold line. You can see just a tremendous surge starting in early October as we approach the holidays, and it's continued to rise. There's been some up and down movements lately, but that may just be a temporary pause in the upward increase. It remains to be seen whether renewed containment measures can really reverse or at least stabilize that virus surge. Now, the increase in the tragic deaths from this virus surge has not been as large as the increase in cases, presumably because a lot of the most vulnerable people unfortunately passed away during the first wave. But the number of new deaths is also at record levels. That red line down there represents a really depressingly large number of daily deaths due to the coronavirus. And I want to just take a moment here to just highlight the human tragedy of this. I'm really focused on the implications for the economy, but it would be I would be blind if I did not mention that these are hundreds of thousands of lives being lost due to the pandemic. that are a tragic loss to U.S. society. And that's a big part. I mean, that as much as anything, that's why we want to get this, more than anything else, that's why we want to get this virus under control. Now, it also has economic implications, of course, and that's what the Fed needs to largely focus on. Now, what this virus surge means is that normal economic activity, as reflected in these kinds of high-frequency day-to-day or week-to-week measures like mobility, just foot traffic at different types of stores, those mobility measures are almost all really depressed relative to normal levels. So you can see in this plot that mobility levels relative to February, so basically pre-pandemic, that's the benchmark for this plot, there's a level of 100 in February for basically all of these series, except for grocery and pharmacies in blue, which are up close to normal activity levels. That line is up close to that 100 normalization from February. All these other measures of activity, consumer and business activity, basically foot traffic in these various types of locations, they're all about 20 to 40% below normal still. And there was maybe a little bit of recovery, but those numbers have sunk back down with the virus resurgence. And so this is what the virus outbreak and resulting containment measures tend to do, is they tend to reduce mobility. We're just not seeing people out and about. What consumer spending is going on is largely oriented around online sales. We saw a tremendous acceleration of the shift to online sales during the holiday season. So until the virus is contained, this kind of thing is going to continue, and we're not going to see a resumption of more normal social and economic activity. The other thing that that I'm personally quite concerned about is the shift in unemployment away from temporary layoffs and towards more permanent or persistent job loss. So this is a breakdown on a month-to-month basis in 2020 of the composition of unemployment. This is a breakdown so anybody who's unemployed, when they respond to the monthly survey that counts the unemployed, they're asked their reason for unemployment. Now, if you look at the bar for April, towards the left-hand side of this plot, you can see that in April, the lion's share, something like 85% of all unemployed individuals, reported themselves as being on temporary layoff. And these are people who expect to get rehired by the employer they left once that employer starts ramping back up again. Now, many of those temporarily laid off individuals did get rehired during the summer. So you can see that light blue temporary layoff bar really decline in size tremendously over the spring and summer months. But what's been happening since then is that red bar, which is permanent job loss, these are individuals who don't have a job to go back to. They're going to have to find a job with a new employer, perhaps in a new industry or occupation. That has been growing, and that tends to slow down labor market recovery because people who have permanently lost a prior job and are searching for a new one, it always takes them longer to find a new job than the temporarily laid off. There's also a lot of labor force re-entrants. That's that yellow or gold portion of these bars. And these are people who maybe lost a job, dropped out of the labor force for a while and stopped actively searching, and now have come back in and are actively searching. It's going to take a long time for those people to find jobs as well, because many of them are permanently separated from a prior job. So unemployment has shifted away from this kind of temporary layoff composition and much more towards more persistent or permanent job loss that takes quite a while to reverse. So that's part of the reason why the decline in the unemployment, that's the main reason why the decline in the unemployment rate has slowed down so much in recent months. The other issue is that labor force participation, the fraction of the adult population that's either working or actively searching for work, that's dropped tremendously. So there's, for example, it's especially pronounced for women who have young children, who can't return to their jobs because they're having to do extra childcare because schools are being held in a virtual format and their children are at home and it's hard to get childcare. And so I'm not showing you the breakdown between men and women, but that breakdown does show that this decline and limited bounce back in labor force participation has been especially pronounced for women. So this is another uneven impact of the coronavirus pandemic and the resulting economic downturn. And going forward, this will be something that employers are going to have to grapple with, is how to get these people back into the labor force. One of the concerns that's been raised about the recovery is whether unemployment insurance payments, which last year for a time were extremely generous, and then in the coming months are going to be fairly generous once again, whether that's going to slow the labor market recovery because people who have generous unemployment insurance payments available to them may prefer to stay on unemployment insurance and not take whatever job offers might be made to them, or not search very actively for a new job because the unemployment insurance benefits are sufficient to keep them in their homes and spending on consumption at some reasonable target level. Some research that I did with a colleague at the San Francisco Fed, I'm not going to go into detail on this because I'm kind of pushing my time limit here, but this the research we did found that those generous UI payments, that $600 weekly supplemental UI benefit that was available from April through July of last year, that did not appear to limit job search and job finding behavior by UI recipients. Quite the opposite. What appeared to happen is that in areas where that $600 really made a huge difference relative to normal wage levels, that's that 90th percentile line here, job finding actually was higher in areas where those UI payments made the biggest impact than it was in areas where those UI payments made a more limited impact. So anyone worried about the renewal of supplemental UI benefits, the $300 a month that was passed as part of the new Congressional Relief Act, anyone worried that that might slow down job finding because people prefer to remain on UI rather than accepting new jobs and moving out of unemployment? The research, all the research I've seen, including my own, suggests that that's not going to be a problem, that people on UI benefits know that those benefits are temporary, and if they have a job offer, they're very likely to just go ahead and take that job offer. The other thing I should mention quickly is that to try to achieve this economic recovery that the Fed anticipates, in August, the Fed announced a new policy framework that's the culmination of a few years worth of analysis and public meetings designed to try to figure out how best to approach achieving the Fed's goals. Essentially, so this was announced in late August. And what this announcement did, it's an announcement of how the Federal Reserve approaches monetary policy, how we define our goals and how we try to achieve our goals. And the two goals that we have are the so-called dual mandate. Those are the two main goals, and those are maximum employment and stable prices. In this announcement in August, maximum employment was redefined. It was acknowledged to be something that changes over time. It's not a single target that's fixed over time. And what the Fed plans to do is focus on shortfalls. That is, if we're falling short of maximum employment, then we're going to likely to have very stimulative monetary policy. And there's not going to be any real concern about overshooting, going beyond that maximum employment goal. And it's also been redefined so that it's a more inclusive goal and pay some attention to groups that may be left out of traditional labor market recovery. The other aspect of it is that inflation rather than just trying to aim for achieving 2%, the goal is to average 2% over time so that inflation expectations are maintained at 2%. That means that overshooting 2% is okay and in fact quite likely. So if inflation rises above 2%, it's not something that monetary policy is likely to react to immediately, because the goal is to have some periods above 2% to make up for periods that were below 2%. And that more aggressive approach to stimulating the labor market, making sure inflation is sustainably at 2% on an average basis, that's likely to lead to more stimulative monetary policy over a sustained period. So in conclusion, there's a long road back following the COVID-19 disruptions. The lives lost can never be regained, but fingers crossed the economy will at least regain the losses that it suffered over in 2020 and will be back to normal over the next couple of years. It's going to take quite a while for unemployment and labor force participation to return to normal. Inflation, same situation. It's going to be a while to get it up to and above the 2% target, so it's averaging 2% over a multi-year period. There are downside risks. This whole scenario is largely dependent on the path of the virus, the success of the vaccinations, both in terms of their reliability, their impact, and widespread take-up of the vaccinations. And in the meantime, while this recovery is going on, the Fed is prepared to use its full range of tools, the emergency lending facilities, asset purchases, all the things I mentioned to make sure that the recovery stays on track. And if you want more information about some of the issues that I discussed, that statement of the Fed's monetary policy strategy, there's the link to it at the top there. The forecast I discussed, there should be a new version of coming out on January 15th with discussion. That's in this publication called San Francisco, the FRBSF Fed Views, which is put out most months around the middle of the month. And it basically gives an updated discussion of current economic conditions and our outlook for the economy going forward. And that's written up by a rotating set of economists at the San Francisco Fed. And then finally, this research about the UI benefits that is in a short publication that I've listed here that includes me as one of the co-authors on it. So with that, that covers what I wanted to present, and I'm happy to take questions.
Why does the Fed want to keep inflation at 2%? Is there a reason to do that? It seems like, as a layman, inflation is viewed as bad. So I'm curious what the logic of the Fed keeping the rate high, or not high, but 2%.
Yeah. So 2% is regarded as a level or rate of inflation. It's consistent with a stable economy, and the thing to be, it's essentially a buffer zone between modest price increases and an economy in which prices are falling, a deflationary economy. Now, in a deflationary environment, that's the thing we really want to avoid, because there's a thing known as a deflationary spiral, where if prices are declining, it then becomes very difficult for example, for firms to meet their financial obligations. If their prices are falling, and they've settled their contracts based on a certain set of prices, and then their prices drop, it can be hard to meet their wage obligations, that is their wage and salary obligations to their employees, and it can be hard to repay loans that were originally settled in terms based on the current set of prices. So deflation is really something that is very much to be avoided. And that's something that Japan has struggled with for a couple decades, where they actually did see deflation, and it kept their economy very weak for a long time. So you might say, well, then why not target zero? And the problem is that once you're around zero, if you get an economic shock that weakens the economy, then deflation can start. And once deflation starts, it can be very hard to reverse it. So that 2% target is intended to be a buffer against deflationary risks. And 2%, small price increases like that, the research suggests that people aren't bothered by them. A little bit of increase on an annual basis is not problematic for either corporate planning or household planning. And so it's not problematic, and it provides this very useful buffer against this very undesirable deflationary spiral that's a meaningful risk and has been observed in other countries in the recent past.
How do you think the newest administration's coming in and suggesting it'll raise taxes on business will have an effect on the long-term business prospects as we emerge from the pandemic?
There are political elements to that question that I'm not in a position to address. The general view of many market participants and other analysts is an expectation for a more expansive set of fiscal measures to be in place, and certainly in the near term, those are likely to push up economic growth, at least in the near term. Taxes, it really depends on how they're arranged. It depends on what the tax money is used for. If it's used for productive purposes, then taxes on business don't necessarily constrain economic growth. It really remains to be seen exactly what the incoming administration and the new Congress are going to do. I've seen a lot of talk about proposals they might put in place, but not a lot of specifics. So business taxes can be a constraint on growth, but if they're designed carefully, what we've seen in past decades is that they can be quite consistent with a healthy business sector, in addition to very stable consumer spending, which also supports the business sector, and healthy economic conditions overall. So without seeing some specifics as the new administration and Congress start putting them into place, that's about all I can say.
Rob, the St. Louis Fed has got a great set of historical economic data. Many people know this as Fred. Is there a like set at the San Francisco Fed? And if so, how would we find it? And what's your focus in San Francisco?
Yeah, so St. Louis Fed has a nice monopoly on that historical economic data. There's no reason to try to compete with that monopoly. They're the main provider of it. They do a great job of having this huge compendium of data available, and that's widely available. Other people in the Fed rely on it, and people throughout the outside world rely on it heavily as well. San Francisco Fed has a number of different indicators that we've developed that have to do with activity in the information technology sector of the economy, wage changes, a breakdown of the source of price changes in the economy, and those are all on our website. I don't have the link immediately available, but if you go to the San Francisco Fed website, you'll see a variety of different specialized economic indicators that we've developed. We largely rely on official data from the various government agencies. And of course, what the St. Louis Fed is doing is basically taking those official data and putting them into a single source in a clearinghouse framework. And so we're all really using largely the same data. The Federal Reserve Board does compile some of its own data series. And as I mentioned, we do have some specialized series that we compute and publish, but not a real wide range of them.
the beige book. Is there a standard format for compiling this? And how do you really go about getting your arms around all that data?
Yeah, so just for others, the beige book is put out 8 times a year throughout the Fed system. Every Federal Reserve Bank, all 12 Federal Reserve Banks, write up a report for their region or area of the U.S. And it's done in conjunction with the FOMC meetings. It's released publicly a few weeks before every FOMC meeting. It's based on anecdotal information, reports from businesses and government agencies and others about what they're seeing from the trenches in terms of economic activity. So this anecdotal information, as Bill mentioned, we do have this huge geographic area, and so we're not, even pre-pandemic, we weren't going out there and visiting with people to gather this anecdotal information. Instead, what we do at the San Francisco Fed is we circulate, actually, we provide an online questionnaire via standardized question surveying instrument. And there's a standard format for many of the questions, but then we have a rotating set of what we call special topic questions that reflect issues that are particularly pressing at the moment. So this is done 8 times a year, and the pressing issues vary from month to month. And so we change up those questions to try to get at the information, the anecdotal information that we feel is most important at that specific point in time. So it ends up being pretty good coverage of our district. Our district is the 9 western states. As Bill mentioned, that includes Alaska. It also includes Hawaii. I wish I could go out to Hawaii and collect that anecdotal information in person, but we don't do it that way, unfortunately. And so we've got those 9 western states, and we get pretty good coverage from all of them. We always get multiple contacts from all of those states who are reporting in from various different industries and sectors about what economic conditions are like.
You're one of 12 districts. What kind of liaison do you have offline from the every 6 week meetings of the Fed and then the Fed report? Do you liaison in any methodical way with other districts?
We're a big, happy family. We talk a lot. Those of us in the research function in the Federal Reserve System, each Federal Reserve Bank, all 12 of them, have anywhere from about 20 to 40 PhD economists who are working on the kinds of issues I was talking about today, coming at them from lots and lots of different angles. The Federal Reserve Board in Washington, D.C., which is basically the headquarters for the whole system, in a sense, they have something like 250 PhD economists. That's just an estimate off the top of my head. It could be a little more, a little less than that. And so we've got a lot of PhD economists doing research, and we're talking about it with each other. We have internal system conferences. When it comes to thinking about policy, we're constantly communicating with, or not constantly, not every day. Every day I talk with other people at the San Francisco Fed. On a pretty regular basis, I talk with people at other banks, or at least email with them. I have some very good colleagues, close colleagues at the Atlanta Fed who work on some of the same labor market issues that I do. And every month or two, I have some email exchanges with them to find out what's the latest information they have on a particular issue and what kind of work are they doing on it. So there's co-authorships of research papers across Federal Reserve banks and with the Board of Governors. It's really a pretty, I wouldn't say tightly knit, but a closely collaborating network. We often come at issues from a very different perspective. It's a diverse set of views within the Federal Reserve System, but the research that we're doing has a lot of overlap and a lot of collaboration to it.
Obviously, COVID is kind of the king of the mountain now. And so there's a lot of focus on it. What is the next largest issue that the Fed would be concerned with?
Probably what's going to happen with the fiscal package. How effective is it going to be at stimulating the economy? What impact that has on government debt and the markets for government debt? I wouldn't say those are issues of concern. They're issues that are worthy of monitoring. And then I think, so that's one issue. I mean, under any circumstances, this kind of fiscal package, there's a lot of uncertainties attached to what kind of impact it's going to have. And then I think the other thing that I haven't really mentioned during my talk, but that's of growing importance and attention within the Federal Reserve System, is the unevenness of much of the gains from economic growth in the U.S. economy. The Federal Reserve more and more is concerned about essentially inequality in economic growth, the fact that some groups of people tend to gain a lot from economic growth and tend to see their income and wealth go up quite a bit, whereas other people in the U.S. economy, their income and wealth doesn't seem to change much, even when the economy is very strong. So thinking about how to make that more even, how monetary policy can be designed so that the benefits of a growing economy are spread more widely and more equitably across groups that might be often left out of that process. That's a big issue we're grappling with now and that we expect to be grappling with going forward as well.
You're a premier economist. You have historical data, trend data, and known unknowns. How do you bring all this together into a cohesive outlook? I mean, it looks to me like an enormous issue. You use best case, worst case, reversion to the mean, probability. What's the methodology and how do you get to the end game of forecasting?
Well, you partially described it. I mean, looking at past trends, and to some degree, there's a certain amount of extrapolation, but it's informed extrapolation based on reliable relationships that we observe in the economy. So, for example, when it comes to the unemployment rate, we know that historically, when the economy is growing, that when we see GDP growth at a certain rate, we tend to see the unemployment rate come down. And so those relationships in the data are pretty easy to then put into our forecast and make sure it's all consistent with historical patterns. Now, historical patterns don't always hold in exactly the same way at any given point in time, and so that's why there's a lot of uncertainty in forecasts. But we can look at things like, for example, this past summer and fall, we were able to see that household balance sheets were actually in surprisingly good shape given the tremendous hit from the COVID crisis. The government relief package had a very positive impact on household balance sheets, and that meant that they were able to keep up their consumption spending. And so that kind of real-time information can be very useful to build into our forecast to give us a sense of whether we think consumption spending will be maintained going forward, and therefore whether the economy, since consumption spending is such an important part of the overall economy and economic growth, then whether the economy will grow in coming months. And that's why there was so much concern about the expiration of the CARES package, the CARES relief package, and many Federal Reserve leaders talking about the need for additional fiscal relief, because in its absence, household balance sheets would have started to deteriorate really severely. I mean, many households are struggling as it is. And without the relief package, that situation would be so much worse. So we're looking at a combination of real-time data, historical relationships, and what we know about the relationships between various economic aggregates like consumer spending, the unemployment rate, and so on. I'm not sure when the question, which is more beneficial, I'm not sure what the alternatives are that are being referred to in regard to which. I mean, there was an expansion of UI benefits. UI benefits are the unemployment benefits that are paid to people who lose a job due to no fault of their own, and there are many millions of them that have lost their jobs over the past 10 months or so. And most of them are eligible to receive these monthly, well, actually weekly payments via the unemployment insurance system. And so those payments are typically about $300 a week, but when the pandemic hit last year, an extra $600 a week was added on top of that. So that was an historically unprecedented increase in the generosity of the UI system. Those expired at the end of July. And the research that I referred to that I did with a colleague at the San Francisco Fed, many other researchers have done similar work both in the Fed system and outside of the Fed system. And it's generally come to the same conclusion that those UI benefit payments don't impede the labor market. There's always this concern that if you give people money while they're not working, they may just decide, well, why should I even look for a job? I'm getting good money while I'm not working through these unemployment insurance benefits, and so I just won't search for a new job. That concern about people just not, about being disincentivized to look for work due to UI payments, that concern does not seem to be a meaningful concern. People realize UI payments are temporary, and so they then tend to, even when they're getting the UI payments, they tend to look pretty actively for a job. And as soon as they get a job offer, they tend to take it.
Okay, the next question is 2% inflation being treated by the Fed as a goal, quote, in and of itself, unquote, or as a reflection of the state of the underlying economy? Put another way, is the Fed more focused on changing inflation or changing the factors that lead to inflation?
Well, it's both. And the inflation rate reflects not just real economic conditions, which the Fed can affect through monetary policy, but it also reflects people's expectations about what inflation is going to be in the future. And so by committing to a 2% inflation goal, taking the actions to stimulate the economy that are consistent with that goal, and being very, very clear and consistent in our messaging about that, that all adds up to hopefully achieving that 2% target on a regular basis. So it's not an either or, it's a both. The Federal Reserve tries to foster economic conditions that are consistent with 2% inflation, but also just getting to that 2% inflation target it's part of our mandate. It's one of our congressionally mandated goals, and it's just we've defined that goal in terms of this particular measure of inflation.
Do you think relief should be more directed, parentheses, and in greater amount, parentheses, to those who were negatively impacted, unemployment, etc., rather than so widely distributed?
Well, it is directed to a large degree. I think that it's hard to direct it more than it is. I mean, my own view is that the UI enhancements are well targeted for the people who have been hardest hit by the pandemic, who have lost their job as a result of the pandemic. And my own view, and this, people in the Fed and outside the Fed will have very different views about this, but I've done a lot of work on the UI system, and my research suggests that it's a very well-targeted source of economic relief, because it's targeted specifically at people who lost their jobs due to whatever economic downturn you might be concerned about at the time. So I think the UI, I was very, very relieved, not to try to use a pun, I was relieved when I saw that the Relief Act included renewed funds for unemployment insurance payments, because I think that is a key element of the targeting that you're referring to. Now, there are people who are struggling who are not eligible for UI payments, who were struggling before the pandemic and are struggling even more. And I'm hoping that the incoming administration and Congress think of ways to reach out more to them in a reasonably cost-effective way. But that is hard. I mean, I know people have expressed concern about taxes being raised and the possibility of that impeding economic activity. I think that's something to always pay attention to, but at the same time, not forget about these people who are not being reached by the current relief measures that have been taken or being considered.
Historically in the U.S., worldwide economy, how is COVID compared to other economic downturns such as war and natural disasters? And how is the current economic recovery mechanism planning compared to previous cases?
COVID is unique in that it's like a natural disaster, except a sustained natural disaster. So typically a natural disaster, like a hurricane, an earthquake, they take a terrible toll, often in lives as well, but they're really limited in duration. And with the pandemic, there was an initial huge impact, much like a natural disaster, but then it continues. It's like significant earthquake aftershocks, nearly as large as the original impact, happening for many, many months. So it's like a natural disaster, but sustained. And that makes it hard to deal with. Now, on the second part of that question about how to deal with it, I think that we learned a lot from past crises. So the Federal Reserve actions so I can only speak for the Fed really, well, partly in terms of fiscal policy as well, but from a Fed perspective, the financial crisis of 2008, 2009 caused tremendous innovations in monetary policy. The Fed started doing things it had never done in its approximate 100-year history up to that point. We learned a lot from that, and I think that made the reaction to this crisis much more rapid. I mean, we put in place these emergency lending facilities basically at the drop of a hat. I mean, it was almost immediate. Congress acted very quickly as well to get the relief package in place. And so despite the political problems and divisiveness that we see in this country, Congress acted very quickly, and the relief package made a huge difference. So I think a lot of lessons have been learned from past crises, particularly the Great Recession, the financial crisis and Great Recession of a decade ago, and those help with a very rapid and effective response to this crisis. It's not, I don't mean to say that everything was solved very quickly, but at least I think the response was appropriately rapid and designed well from that perspective.
Greenspan called the market at one point irrationally exuberant. Do you think today's market is irrationally exuberant?
Yeah, Greenspan called the market that back in the mid-90s, and then the market kept on going up for quite a while, although eventually there was that popping bubble that happened in 2000. I think now, the market participants are really looking through the current crisis, and they're looking forward to what the economy is going to be like when it's largely recovered. So market participants always want to anticipate whatever pickup happens. They want to beat the other person to the equity gains, and so they tend to bid up prices even before the real economy has shown significant signs of being back on track. So it's that forward-looking element that I think is going on. I wouldn't call that irrational exuberance. I would call that taking a bet that the future will indeed be as good as many people are predicting it will be, and it's just that you got to buy the assets, you got to buy the shares now before the price has already gone up. The other part of that, though, is that the market is market value largely reflects a lot of these big tech companies, for example, which are doing quite well despite the pandemic. The shift to online activities and so on has really given a boost to their business model, and so that's reflected in their stock prices. And so those two factors together make for a market that's very strong, and I wouldn't call it irrationally exuberant, but it's more a matter of looking forward to normalization.
Wasn't food and housing taking out of the inflation calculation? ? Some people don't trust the inflation rate. So I'm assuming the question is how trustworthy is the inflation rate?
Yeah, they're very trustworthy. I mean, so first of all, there's two main measures of inflation that I reported in my chart. So in this plot here, there's the headline measure in light blue takes account of all prices, includes housing, includes food, and includes everything. It's a very, very broad measure of all prices in the economy. The darker blue core measure does strip out energy and food. And that's because those tend to be volatile. Sometimes they go up a lot, sometimes they go down a lot. And for a more reliable measure of inflation looking forward, that core measure that strips out the volatile components is found to be more reliable. But that doesn't mean that the Fed is only looking at that. Ultimately, what we're trying to achieve is 2% inflation on a consistent basis for that headline measure that includes food and energy, as well as all the other prices. The other thing I'll point out is that this measure of inflation, which is put out by the Bureau of Economic Analysis, that's part of the Department of Commerce, it's based on their measurement of GDP, so it's closely related to their measure of overall economic activity. Independent external assessments of price inflation, based, for example, on prices available over the internet, millions and millions of products sold over the internet. It's possible some researchers have looked at price changes based on those internet posted prices, which are actual prices for items sold on the internet, which is a pretty big share of everything that's sold at this point. Those and also just advertised real prices that get posted on the internet. You get inflation outcomes that are very similar to this PCE, price inflation measure, and also the CPI, the Consumer Price Index, which is the other main government-produced measure of inflation. So these measures of inflation all show very, very similar rates of inflation. And, there's some people out there who say they have some alternative measure of inflation that shows much higher inflation or much lower inflation than the official government measures. Once you start poking at those a little bit, it becomes clear that the methodology is severely flawed, and most of those alternatives have been debunked. Thank you. It was a pleasure talking with you.